All right, we are live. Hello, everybody. Welcome to the session. We will kick it off in just a minute, but just wanted to say hello to everybody and welcome. Very good, very good. Teresa, very excited to have you here with us. So Teresa Anania is the Vice President of Global Customer Success and Renewals at Zendesk, where she is responsible for the management and development of the company's global client base, including all customer segments from enterprise to the smallest customers out there. So her job is to ensure that Zendesk customers are realizing the maximum business value across the customer lifecycle and achieving all of their goals, return on investment, and all those things that we hope for when we invest in an awesome software like Zendesk. So prior to Zendesk, Teresa was the Senior Director of Customer Success at Autodesk, where she ground up and created the scale that they have today. And so Teresa is passionate about developing personalized, outcome-driven experiences that advance customer adoption, retention, loyalty, and lifetime value. So with that, thank you so much for joining us today.
Yes, I am so excited to be here. And this is one of the most important topics, I think, which is measurement. Measurement is such a critical element of how we tell the story about the impact that customer success and even renewals is having on the organization. And it all starts with ensuring that the customer is seeing the value in your solutions. And then how do you quantify that? How do you ensure that you can deliver on that and then be able to tell that story in the C-suite? Because I think we all struggle with this question of how do we know how much to invest in customer success? And how do we scale this to really keep up with the times about how the business, maybe if it isn't monetized, can still be directly attributed to the customer, to the business goals? So let's just get started right away because I am super excited about this topic. So I kind of break down the dashboards that I use every day into 4 main areas. So you definitely want to have something that is about your overall objectives and key results. And this is where attribution and being able to attribute the work that the CS and renewals team is doing directly to those goals, because these are the things that resonate right in the C-suite, okay? The second area is looking at a portfolio. So breaking down by region, by even sub-segment, what are the accounts that are making up the portfolio that I'm going to expect my leaders to be running? What is the account health of that portfolio? What type of book of business are we managing? This is where you could do a lot of great capacity planning. You can think about is your average size of your customer deal growing? Is it dropping? What is the account health trend happening in the portfolio or even in the aggregate? The third area is around kind of a double click of that portfolio. What accounts are actually in that portfolio? And more importantly, what are the key attributes about those accounts that you want to capture as a business so that you can make even more intentional assignments of your CSMs to assure that whether it's industry specialization or product specialization or even size of company, key things like that. How do you want to capture those so that your assignment of the right CSM to the right account is happening? And then finally, you have your operating metrics, which is what you're expecting from your team, individual members. You might base it on what great looks like, what a superstar CSM is achieving, and their operating kind of means to the end. And then you can use it to determine the white space. Where is the white space? This could really help augment great conversations with team members, from a manager to an individual contributor, about where they might need some areas of growth. So anyway, these are the 4 main things that I look at when I think about measurement. Okay, so now let's double click a little bit. What are the key business goals that I am asked to achieve at Zendesk and even in my prior life at Autodesk? First of all, most importantly, reducing churn and contraction. That is by far, for my organization, the number 1 goal. And we measure on that accordingly. We also comp on that because I think compensation really does have to match the expectations you have for the team. Well, the other part of the job is all that we are retaining, right? So yes, we want to minimize the loss of any contraction or churn with a customer, losing a customer, but we also want to honor and celebrate all the great customers we're retaining, because that retention is the very foundation on which expansion can occur. And this is where you get that machine of expansion and the ability to start attributing some of your work to not just minimizing churn and contraction, but growing the account lifetime value. And that's where NER comes in. Some of you may call that NDR, NRR, net dollar retention. We call it net expansion rate. It's really just looking at the beginning period, ending period, whatever that period is. What is the account growth? And it really does kind of take into account both the churn and contraction, or I should say the contraction that might occur in that account, and the expansion. So it's really important that you know the pieces of this metric and you don't just broad stroke it with only focusing on NER, because you could be masking a lot of unhealthy contraction just because there's also some great expansion. So anyway, these are some key metrics that we measure in our business. I wanted to make it real for you so you can see how we're doing this attribution modeling. So the next thing you want to do is you want to think about, okay, your final, if you look to the far right, goal and objective is the lagging indicator, let's say renewal rate in this case. Okay, that's the retention metric I just talked about. But you got to back up and think, what are the leading indicators that we're going to look at that might help us know when we are likely to retain a customer? Now, I'm not talking about having to do significant data science here. I like to take a very pragmatic approach to measurement. And so what we did is we did some correlation work, which I'm going to show you, but we decided that a successfully onboarded customer basically would have 50% of their seats they're entitled to utilized by month 3. So you could develop your own metrics for what successful onboarding looks like in your business. That's what we chose. We also said that by the end of month 6, they're going to have 75% not just provisioned and being used, but actively used. There's a little different definition for that. And then we also look at adoption. We want to know, okay, they're not just using the tool, but are they deeply adopting some of the capabilities that we know in the maturity curve are the ones the customer needs to be leveraging in order to achieve the full ROI potential of our solution. So just for, again, pragmatism's sake, we identified several key capabilities that we know correlate to that end result, which is renewal rate. Okay, so once you've decided what your leading indicators are to achieve that ultimate lagging indicator, you do want to make sure you are basing those leading indicators grounded in what correlates to renewal rate. So we did find, I told you we're looking at support seat utilization of 75% by month 6 and having the provisioned up at month 3. We found a very strong correlation and all you have to do is go backwards to look. Do customers that we retain have basically that amount of utilization intact? Yes. Customers we lose do not. This is the simple positive correlation that helps you know that those leading indicators are actually grounded in something that's going to translate to renewal at the end. Same thing for the support features. I mentioned in our case, we have about 7 critical features that have been identified as those where advanced customers who are achieving full ROI are likely to have started to leverage those in the Zendesk solution. So again, a correlation study with our data science team proved a correlation. So we knew that those leading indicators were going to help us achieve that ultimate renewal rate. All right, once you put this all together, folks, one of the things you need to do is think about engagement. So if you look to the left, what we did is we kept it simple. So you want to know that your CSM engagement is actually attributing to these leading indicators and then ultimately the lagging indicator of renewal rate. If you don't use engaged versus unengaged, you have a really hard time doing the attribution, right? Because what we want to say is that when we engage, customers are more likely to onboard successfully than when we don't engage. Same thing. customers are more likely to adopt those 7 critical features in our support technology when we engage to drive in that use, if you will, that adoption, versus when we don't engage. So what we did is we simply broke out, because you could say engage. What does engage? How do you define that? Well, keep it simple is my rule of thumb. So we just took our high touch, our medium touch, and our low touch, and we said, look, 1 or more engagements on the high touch is going to include in the engaged cohort. Unengaged means there was no engagement. And then we're going to look at the same thing with the medium touch and the low touch. It's a way to keep it simple. I'll show you a way once you get a little bit more advanced that you can even, actually stratify your engagement levels to see if higher engaged actually attributes more to that outcome. But this is a way to keep it simple. Now, you might say, and I have faced this challenge before, if no engagement is your basic control group, isn't that biased? And yes, I would say it could be. What we did is we actually just happened to have, frankly, because of capacity, we were unable to really engage with all of the customers that were in these ARR cohorts. So we looked at that kind of we weren't able to reach out, whether it was someone was on sabbatical or we had a leave of absence, or we actually had, someone leave and we didn't have backfill. If they weren't engaging with, our CSM over a period of time, that is an unengaged account. And it wasn't someone that actually didn't want to engage with us, because that's where the bias comes in. And you will always have some bias, because what we don't want to do, at least my point of view, is that we don't want to suppress a group to have a true control group, because you're basically neglecting your customers. And the whole point of this is not to prove something internally that you're having an impact to the disadvantage of actually losing customers over it. So my view is if you can do some matching and getting a cohort of unengaged to have less of a bias, and then still just recognize there's going to be some bias in there, I think you can still make a very compelling case in the C-suite. All right, so I just now want to blow up a little bit the impact that we're seeing on the gross renewal rate. And what we can see is when you take this slightly biased, but mostly a control group that is called unengaged, and you compare it to the engaged group with the simple definition I gave you, you can see the impact, consistent impact that the CSM engagement is having on the ultimate goal, which is the renewal rate. But you can also see this when you start stratifying. And I was mentioning, as you get more advanced, you can say low engaged equals 1 engagement. High engaged, you could say is 2+, or you can even say over the life cycle, the maximum touch point plan would yield a 10 touches with a customer, let's say. You can say if they're getting more than half of those and connecting with that customer, that's high. And anything under that is low. So this is a way for you to be looking at not only the actual impact, but then breaking it down to understand not only how much engagement is making a difference in the high and the low engaged, but you can even get to the point of attribution of the engagement types and the ones that are having the bigger impact. Here, I'm showing you the impact on renewal rate, but you do this same thing on what you define as onboarding success. You could do the exact same thing, what you define as adoption success. And this way, you're able to use this not only as a measurement model to show impact in the boardroom, and to secure investment dollars, but also to help improve the levers that are working for your organization and those that you can dial down that aren't really working. So here, I actually created another framework that allows us to go beyond year 1, because I think we all know in the CS world, a customer adoption journey might seem more consistent for that first year customer than every year thereafter, right? Because customers have different velocities in how they're going to consume and take advantage of your capabilities. So here we actually created a different model for customers that are more tenured over 1 year. We actually are looking at other capabilities that indicate likely retention. Here we look at omni-channel. For us, the more channels they're using in the support experience they're delivering to their customers, the more likely they're getting more value out of Zendesk. So that's why we pick that. And then also ticket volume. So the more tickets that they're solving using our solution obviously would mean a customer getting potentially more value. That's the proxy for value delivery. So again, we just make sure in this framework that those things correlate to the end renewal rate. And you can see here that highly configured using more channels absolutely correlates nicely to those customers that we retain. And then the same thing, we actually here are showing an example where I'm correlating or attributing the success engagement to now the leading indicator. In the case of the 2+ customer was highly configured. And you could see the remarkable difference between those we're engaging with and those we haven't engaged with and the uplift. And then you can dollarize this when you take this all the way to the end of the renewal rate. I want to mention, though, one of the most critical things about this measurement model is making sure you're driving the right motions to actually achieve this, right? So if highly configured is what adoption success looks like for my tenured customers, then my plays in the CS organization are all about driving that high configuration. So I just want to mention that is a key part of this. Then we show attribution to the final renewal rate for the 2+ year customers, which basically also showed a very significant uplift for those we engaged with those we didn't. So the last thing I want to just share is another example of a little bit more advanced model, which now don't think of this framework as limited to only what you do with your CSMs. Think of this more broadly. How do we also include the digital engagement with our customers? So we actually show things like CS engaged, digital engaged, CS and digital engaged, and then we have a cohort of CS, digital, and renewals engaged. Or we might just have renewals engaged, but no CS engagement, because like size of company, we might be addressing them in the renewal motion, but not in the CS motion. So you can stratify your cohorts of customers based on engagement, possibilities, and actually see what is having the biggest impact. Our theory was that digital and CS engagement would have the biggest impact. And then CS only would still have large, but not as much as unengaged. And then digital only would have a little bit of an uplift over unengaged, but not as much. So those are some of the theories you could be testing out. And again, this helps you optimize your levers. Do we want to invest more in digital because that engagement uplift, is having a great outcome in onboarding, adoption, and ultimately renewal rate? Or do we want to put more of our resources into the CSMs, the human capacity? This is the way you can leverage this model. So I love talking about a crawl, walk, run, because I believe it is super important to recognize that you have to start somewhere. We started with digital and we said email only. We're not even talking in product yet, right? And that was our crawl. Then we looked at, okay, let's have engagement tiers, high, medium, low, like I showed you. Let's do all digital, in product and email. Then we built out a model for digital and human, or human only, right? And then we also like to look at more of those onboarding metrics, maybe even first time to value would be an aspirational outcome instead of just like utilization and how much, what percentage agents have been actively using. So we're going to start to look at how do we measure first time to value and use that as our outcome from the onboarding experience. So I just tell you that start with what you have and recognize that it can be a phased approach. Now, this is kind of what my dashboard looks like. I just have a visual up. It's meant to be a bit of an eye chart here, so you can't read it all, but it's my portfolio. It's looking at my book of business quarter over quarter, my available to renew. It's looking at my account health in the pie chart. And then you could drill in and really see where are my red accounts and what's coming up in the renewal base. It's not just for me, it's for all of my leaders to be able to manage their portfolios. So this is just an example view. And then what I wanted to share with you last is just that you can translate then the uplift in the renewal rate. Look here how I have engaged and then unengaged you can show we have a 10-point difference in our engaged cohort. You can dollarize the savings of churn and contraction that is yielding your company, so that you have a model where you're saying, like, for every CSM engaged in a year, we're saving 500K in ARR. So that pays for itself, at least double in a year. And again, this is conservative because of the way we've built this model, but I just want you to recognize that the savings can be dollarized, and you could bring that straight into your investment modeling for your planning activities of how to ask for headcount. So my final takeaways, and then I'm going to take all your questions, I hope you have lots, is start with what you have. I say that a lot. Don't wait for perfect data. Start with identifying what are your key business metrics at the end of the line that you want to measure. Those should be pretty standard. And then what are the key leading indicators that you believe will help get you to that ultimate retention? Build out your engagement method with the customer at the center. You got to be thinking about, again, not just the measurement and being able to make this case, but let's not neglect any customers for the purpose of having a perfect control group. And let's also be driving the motions in the CS practice that allow us to see that successful outcome in the measurement model. Otherwise, we're measuring something we're not even driving. And then finally, measure so you could prove ROI, but it also helps you identify your white space. It helps you identify the levers that are working, the things that are not. So it is really meant to be more important in helping you run the business than just being used as a way to create an investment business case. So that is what I wanted to share with you today. I would love to hear your questions.
That was awesome. Thanks so much, Teresa. That was like action-packed. I feel like I'm going to have to go back and watch it a few times and like really dig in on a bunch of slides. So very well done. Thank you. Ton of information in there. I love it. All right. So I am opening it up. Anybody who has questions, feel free to toss them in the chat. But until that point, I'm definitely going to kick off with a few questions that I have. And I know a few others are wondering the same thing. So I think one of the, taking one step back from the presentation is there's so many people talking about product-led growth today. And right, we're on this PLG Disrupt event. And so I'm just curious sort of what your thoughts are on this market today and all the excitement it seems to have over the last, couple months. And just any thoughts in general that you sort of have or want to share about, how CS might be changing going into the future and how product-led might have a role in that. And any thoughts?
Yeah. Well, I love product-led because it is a true way to have more of a self-serve option, a scaled model. I will tell you a lot of our motions in the CS practice are to remind customers about what they can do in product, to add agents, to add capabilities. Have you seen some of the tutorials that help you learn some of the capabilities that we believe others like you are using and getting great value out of? So we're constantly, like, even though the human might need to engage in your higher ARR accounts, we are taking them back to the product to ensure that they're getting the full value. And we believe it starts at time of trial. Like, honestly, that is like if you have a trial experience, that is your first 30-day test bed of how quickly can you get a customer successfully using, adopting, and already seeing value in that 30-day window. And you can't do that without an in-product experience that helps drive that and gives you some of the insights back so that you know which customers are on the healthy track. Through the in-product and digital methods, you don't even need to engage with a human. And then which customers might need intervention, even in that 30-day trial period. So I believe the evolution of CS right now is really grounded in two big things. One, scale. You have to be able to leverage digital across the book. Digital is no longer like relegated to just your long tail. It is meant to provide a self-serve option that takes customers on those very journeys that we believe show successful onboarding, successful adoption, and then ultimately value delivery. But it's done in a way where the customer doesn't need to interact with a human if they don't want to. And then you can always have your hand raisers that say, I need some help. And that can be your way to engage. The second big trend, in my opinion, is having success driving the expansion motion. I believe if you are truly doing value delivery, and you know your maturity curve, and you know that customers on the far, far right of that maturity curve are realizing the highest ROI, then it is your job as a CSM to take them on that journey. And whether it means they need more capabilities and products than they have today, that's part of it. That's the outcome of that discussion. It's not like a selling job. It's more like a helping them mature and adopt and really master the capabilities you offer. And the only way you could do that is for them to unlock all that you have. And that's where you end up with that white space of cross-sell, upsell. So I think, and the other thing I love about it is it really creates that true like self-funded model where you can say, like, not only are we attributing our engagement to retaining customers, but we're also driving 10% growth on the account base. And, it doesn't have to be in competition with sales. It can be in partnership with sales. But to be able to say, like, that's the expansion we're driving is a real plus when you're trying to make that business case.
Yeah, I think something that's really interesting too, and that you were touching on too, is that, it's like everyone starts to become way more familiar with the product and the opportunities for the customer to better adopt your product and get more out of it. So whether that's cross-sell or upsell, the CS team being focused on it, sales thinking about it, marketing being aware of it, it becomes sort of like this full team effort. And I really like your idea of, not only helping the customer where they are today, but thinking about where they want to be in the future and making sure that they're successful in that.
That's exactly right. I see a question posted around the concept of CAC, and cost of acquiring and then cost of retaining a customer. I mean, I think we all have the general industry data that, of course, it's more costly to attract a new customer and less costly to retain a customer. But I do think I showed you some of the investment ways to prepare a case to indicate the importance of, like, one CSM can reduce churn and contraction by 500K ARR in a year. But it's really important for you to look across that post-purchase customer journey and determine what all resources are being brought to bear for that customer. And how do we, again, stay pragmatic, stay simple? How do we dollarize the cost of retaining that customer? And I think it's important to have the compare so that you can say, like, not only are we assuring that there's a good ROI on a CSM headcount, but we are also showing that by not losing that customer, you can do the delta of therefore not having to gain one new customer to make up for that. So I think this model only works when you look at both sides. And I do think you can pragmatically look at the cost and the human time that's going into any of your free offerings. And then I do highly recommend you thinking about monetizing offerings as you get into the higher ARR, because customers, if they're seeing a true value in like a very specialized VIP support experience, they should be willing to pay for that. So I think that's a way to kind of think about it too.
Awesome. Thanks, Teresa. We have one more, hopefully quick question, and then we will pop off in just a minute or two. But what job titles are reviewed and compensated based on reducing churn and contraction? CX roles, product management roles?
That's a great question. Well, the way we're doing it at Zendesk, I mean, may not be the best and ideal way, but I do find this pretty common in my peer-to-peer network, the way we're doing it. So we are comping our job titles for CSMs on a variable plan, 80-20, 90-10, you pick somewhere in that range. The variable portion is 100% today on churn and contraction reduction. So think of it like an attrition budget. Now, do I have every other supporting cast member in our go-to-market also comped on that? No, I don't. In fact, we're really big on holding people accountable. That is their number. Now, do they need a village to make sure we retain the customer? Yes. So other goals and metrics like in sales and professional services and support are corollary, but there's no one else that holds that churn and contraction number except my team. That puts us in the perfect place, including my renewals people, to actually be in the lead on any negotiations around the renewal, et cetera. So I think that's super important. Now, what we're evolving to is we're going to take that variable piece, let's say it's 80-20, the 20%, and we're going to split it. Half of it's going to be related to the churn and contraction goal they have today, and half of it is going to be related to that NER goal that I talked about. So what expansion is happening in those accounts? So we could start celebrating that, okay, you're reducing churn and contraction. That's great, but it's kind of like still a loss for the company. Let's look at the flip, which is what you're retaining and how much those accounts are growing, and give my team a piece of that action as well.
Awesome. Great answer. Thank you so much, Teresa. This was incredibly insightful, and I appreciate you answering all these questions. Awesome to have you here, and hopefully we'll get to catch up again soon.
Great. Thank you. Great to be with you. See you.
Bye.